Finance Coach. My mission is to help you to become a confident and independent investor and to reach financial freedom and security. In my webinars, I share with you knowledge on how to manage your personal finances. I also give you insight into the financial markets and products from an investor perspective. ETF or mutual fund? Which one is right for you? This is our topic today. ETFs demand lower fees, which makes them cheaper, so better to invest in ETFs. I guess you've heard this. But don't judge a book by its cover. So if you wonder if this is the only aspect to consider, then you're in the right place here. In this webinar, I will share with you the similarities and differences between equity ETF and mutual funds, and how to decide which one is right for you. Please note, and this is important, all financial products mentioned in this webinar are for illustration purpose only and do not express a recommendation to buy or to sell. For a start, let's look at the characteristics of ETFs and mutual funds. Like red and green apples, they are similar, yet they are different. An exchange-traded fund, or ETF, as they're commonly called, is an investment fund that tracks an index. That is, it follows the price of a basket of stocks. Whatever movement the index makes, up or down or sideways, the ETF follows. If the index rises by 2%, the ETF does too. If the index falls by 2%, so does the ETF. Some indices that are commonly tracked are, for instance, the S&P 500, the Dow Jones, the British FTSE, the Euro Stocks, the Chinese SCI, the German DAX, the MSCI World, the Japanese Nikkei, just to name a few. There are two types of ETFs that one can invest in. One physically holds all stocks which make up the index it replicates. The weight of each share in the index is commonly determined by the size of the market capitalization of the company. The other type is a synthetic ETF. The issuer of the index makes a swap contract with a third party, usually an investment bank, which holds the physical stocks. As this product is a lot more complex and risks are much harder to access, it is riskier. ETFs can be issued for shares, for bonds, for commodities, for money market or alternative funds. Mutual funds are also called actively managed fund. A fund manager picks stocks or bonds he buys after analyzing them according to certain criteria. He also decides on the weight these shares should have in his portfolio. The weight is one important factor that influences the return of the fund. Every fund has a defined strategy that is published in the fund fact sheet. The fund manager has to operate within this strategy. For instance, a Greater China Equity Growth Fund can only buy growth shares from China, from Taiwan and from Hong Kong companies. Also, the amount of cash he can keep is usually defined. He cannot invest into bonds or companies outside of Greater China. So as an investor, you want to look at the fund fact sheet to understand what the fund is about and the risks involved before you make a purchasing decision. So how do these two apples compare? Let's look at the similarities first. Both ETF and mutual fund are baskets of investment products in which investors' monies are pooled. These baskets can contain either shares, bonds, commodity, or a mix of asset classes. For easier understanding, I will focus on share funds only. Both investment instruments can be diversified according to geographies, size of companies, industries, and currencies to reduce risk. And thirdly, for investors that would like to obtain an annual income, there are also some ETFs or mutual funds available that distributes dividends annually. And lastly, both ETF and mutual fund are regulated. Now let's look at how ETFs and mutual funds differ. ETFs are traded at the stock exchange like a stock, whereas mutual funds are available through the issuing fund house. So for ETFs, prices are fixed continuously throughout the day as they are being traded, whereas the price of a mutual fund is commonly fixed once a day at the fund house. Mutual fund and ETF also differ in terms of management. A mutual fund is an actively managed fund. Apart from picking the stocks for the portfolio, the fund manager also rebalances their weighting within the fund from time to time. He takes profits from stocks with high valuation and reinvests them, or he sells stocks where the outlook has changed to a negative outlook, keeps the cash, or reinvests again. It's a bit like harvesting ripe fruit from a plant. Discard rotten ones and prune the branches that have grown to encourage fruit growth. It's a constant process of reviewing and rebalancing to optimize the return of the fund. A well-performing fund beats its benchmark. That is, the fund produces more return than its benchmark index. So in a mutual fund there is a lot of active management involved. In the case of an ETF, this is different. An ETF retains the same composition of stocks over a lifetime, unless a share drops out of an index due to underperformance or a share split, or a new stock is included in the index. But in any case, the ETF follows the index, so there is no opportunity for outperformance and no risk of underperformance. Another difference is fees and charges. Is dollar chasing worth it? You might have overheard people saying or even be advised that an ETF is a better investment because its fees are lower. Now I would like to look at this statement a bit closer. It's true that fees for an ETF are much lower. Customary, you will pay 0.1 to 0.75% annually, and there is no initial charge involved. Commonly, a mutual fund charges a front-end fee when you buy the fund and an annual management fee of 1 to 2.5%. So yes, comparing fees, the ETF looks much cheaper. However, having said that, personally, I hardly ever pay a front-end fee, as most banks or brokers have special conditions with fund houses. There's always room for negotiation. There are 8,000 mutual funds available in the US alone, and the competition is huge, so don't be shy to get your money's worth. Also, in the case of a mutual fund, you pay for an active fund management, trading day in, day out. In the case of an ETF, which does not change its basket of shares and cannot outperform the market, hardly any management costs occur, hence fees are low. So from my perspective, ETF and mutual fund are two different things. There is another significant difference between the two products. As an ETF is tracking the index, it cannot beat or outperform it. The ETF is as good in performance as the index.
A mutual fund, on the other hand, is aiming at beating the index, which means outperforming the index it is benchmarking against. Only really top fund managers are able to do this. So you find many mutual funds in the market that are just hugging the index they are benchmarking against. Or even worse, they are underperforming the index. These funds you want to avoid. They are not worth the extra fees you are paying for the fund management. But if you find a true gem, which is managed well, and the management or the management team is achieving an outperformance, then you want to have a closer look, and fees might take a backseat in your decision. Lastly, I would like to talk about another risk and where these two instruments differ. There are two aspects that need to be considered. Firstly, transparency, and secondly, underperformance. As an ETF replicates an index and is traded on the stock exchange, the underlying assets are disclosed daily in full. With a mutual fund, holdings are only disclosed periodically. Mostly, one only finds information for the top holdings. The detailed moves within a portfolio are often not transparent until much later. As with all investments, for more risk, you might be rewarded with more return. But you want to be sure if your personal circumstances and your investor personality allow more risk for more reward. Let's look at some practical examples to illustrate what I have just shared with you. This chart here is comparing the 6-year performance of the UBS Equity Greater China Fund versus iShares MSCI China ETF to date. The UBS fund currently holds 46 Greater China shares, including Taiwan. The China ETF tracks the MSCI China Index, which covers 85% of the Chinese stock market, excluding Taiwan. Both funds have their largest positions in Alibaba and Tencent. The iShares ETF with 34% and the UBS fund with 19%. They also equal in volatility with about 20%. They differ though in the number of holdings, that is, the ETF is much more diversified with 714 shares. They also differ in size. The UBS fund is $1.8 billion and the ETF is $5 billion. Comparing the performance of the two funds, you can see here there is a clear outperformance by the actively managed UBS fund. Even when considering the unusually high fees of more than 4% and the small dividend paid out by the ETF of 1.3.7%, the UBS fund has made 203.27% until October 2020, and the China ETF has had a return of 69.88% excluding dividend. So in this case, the active fund management has outperformed. Now let's look at another example. Here we compare the iShares Russell 1000 Growth ETF with the T-Rowe Large Growth Equity Fund. Both are benchmarking against the Russell 1000, which tracks the largest US stocks by market capitalization. The ETF holds all 1,000 shares listed in the Russell Index, whereas the Rowe Fund selects some or most stocks of the Russell Index. The fund charges 1.58% annually and the ETF 0.19%. Over 10 years, the ETF clearly outperforms the fund. Over 5 years, the fund outperforms the ETF by approximately 8% when taking the fund fees into account. So over the long run, it would make more sense to buy the ETF as benchmark underperformance risks are excluded and annual fees are cheaper.
ETF or mutual fund? Which one is right for you? The choice comes down to how much risk you are willing to take for the possibility of a higher performance. From my very personal perspective, I consider mutual fund or ETF on a case-by-case basis. For funds that require specific industry or territorial knowledge, it is often worth to trust a seasoned fund manager with industry-specific knowledge. When looking at broader markets, ETFs are often well worth a consideration, as it is hard to outperform them. In addition, the wide diversification of stocks lowers the risk of a loss. Niche market ETFs with low diversification and synthetic ETFs are complex products for the private investor. When investing smaller amounts or enrolling on a monthly fund savings plan, ETFs make sense because you can buy ETF for the price of one share. Also, fees are lower. With a mutual fund, you often have a minimum investment amount. But if you find a well-managed fund that outperforms its benchmark by a decent percentage, then it might be worth to invest into a mutual fund. Good fund management does not come for free. And lastly, most importantly, when buying actively managed mutual funds, there is a risk that the portfolio manager may underperform its benchmark. So you want to take a look at the track record of the fund manager and if he is also backed up by a team. I have now come to the end of my presentation and I hope you found it interesting. I would love to hear from you if you have any feedback or if you have any question, please leave them below or send me an email. If you would like to learn more about how you can grow your savings and how my long-term personal experiences in the financial markets can help you, please sign up for more webinars or workshops coming through to you soon. Please also take time to read the disclaimer here. Thank you for watching. Happy investing. Your women's finance coach, Monika Sturm.